think investing is just for experts, Ryne proved everyone wrong.
Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour, Vero here, and you're listening to the Dividend Guy blog podcast. Today, I welcome Ryne Williams to the show, a self-taught investor, full-time content creator, and passionate advocate of dividend investing. Ryne started just a few years ago with zero experience and no financial background, and a famous quote from Warren Buffett lit the fire. So what began as a personal challenge has turned into a mission to show that investing isn't just for expert or the ultra wealthy. It's for anyone willing to learn and stay the course. Ryne, thanks so much for being here. I'm really looking forward to this one. And you might not know this, but Mike knows you a bit and he has talked about you so much in the last couple of years. So happy to welcome. And how are you doing?
Well, first of all, I'm super happy to be here too. I've listened to your guys' show for pretty much, honestly, I would say pretty much since I started investing. I've been listening for a long time. And
Great.
With that said, this is a pretty cool full circle moment for me to be able to be here today and chat with you. So thank you so much for having me on. And I think you really hit the nail on the head. I guess my whole investing journey is about proving that if a simpleton like me can figure this stuff out and hopefully find success with this, and I truly think anyone else can, if there's any takeaway from what people hear today or the other gibberish I put out, if you're familiar with my channel or whatnot, I hope that that's the takeaway because it's true.
Yeah, I'm sure that people will learn to know you as we go and learn also your philosophy. And I couldn't agree more with you, honestly. So for those who don't know you, how would you describe yourself?
Well, I am a diehard dividend investor. Kind of like you said, I started getting into this stuff about 5 years ago. I live in Las Vegas. I'm just a normal guy who one day randomly, decided to get into investing. And kind of like you said in the intro, there was this quote from Warren Buffett. It's that classic quote that goes, if you don't find a way to make money in your sleep, you will work until you die. I just think I was at a time in my life where hearing that really, really kicked me in the pants and made me realize just how much I needed to start doing something like this. And so, yeah, long story short, I heard that. And since then, I've just been someone who is very interested in investing. I'm a big enthusiast. And at the end of the day, I think that's the best way to describe myself. Someone who's just very excited and very interested in investing and wants to share it with the world.
Right. But could you walk us through that moment? What was it like when you heard that quote or read that quote and how it led you to your first investment?
Yeah. So I was working a job at the time that I really had a hard time with. I really did not enjoy that job. And obviously, you can always change jobs. I understood that. But still, worst case scenario in my mind, I was going to be working at this job for a long, long time, worst case scenario. And when I heard that quote, like if I don't find a way to make money elsewhere, I'm probably going to have to do this until I die. In my mind, that was the worst case scenario. And, hearing that at that point in time was a really good motivator to start investing. Growing up, I had a custodian account, which was created by my parents. And so I had a little bit of investing money already. When I was in my early college years, in my early 20s, I'd set up an account just kind of, I think my roommate was doing it and that made me want to do it too. Set up an account on Acorns, which is like an automated investing platform. And so I had a little bit of something going on, but it wasn't anything I took serious at all. And hearing that quote, like I said, it really lit a fire under my butt. And that was just the big catalyst for, everything that came after that. It really all started there. And my want to invest came from being in a bad situation and looking for a way out. That was really my biggest motivator. Does that make sense?
Yeah, right. And I'm sure that some people are wondering right now, where did you find the money to invest?
Well, at the time I really didn't have much. Like I said, I had a little bit set aside. I had a few grand just from the custodian account that I already had invested and, a little bit more in the Acorns account, which eventually I moved over to Stash, which eventually I moved over to Robinhood once that kind of became the cool place to invest. And so I already had a little bit of a nest egg, started.
Hmm.
And then everything after that just came from the income I was making. And I did not start, like when I made the decision to start investing seriously, I did not start putting in a large amount of money. I probably
Right.
started investing maybe $5 a week or $25 a week, something like that.
Hmm.
And over time have, gradually increased that. But it really all started with that small amount. And that was really important, if for no other reason, just to get in the habit of setting money aside. And I think
Right.
once you can establish that habit, you have something good to build on. And so that's really where I started. I did not have a lot of money at the time. And truth be told, I've even today, I've never been a super high income earner. I've never been someone who's made a lot of money. And I've never been someone that has a lot of money to contribute to this stuff. And so just like anyone else, I'm just doing the best that I can with what I have.
That's very interesting. Again, it goes back to, like you said, everyone can do it, right? So you started investing in 2020. I mean, everyone could remember COVID, right? So
Yeah,
that was
absolutely.
it was during a time where market volatility was high. So what was it like learning the ropes during this time of uncertainty, which we could also relate to today, right?
Yeah, absolutely. I don't remember how I felt during that period. I think I maybe started investing soon after the big drop in March. So I think I
Mm,
missed a lot of the big drops. I think I started soon after that. And so I think I came into it at a pretty good time. And I was able to buy, I remember I was able to buy certain stocks like, a lot of which I still have today, like Chevron and Starbucks, Procter and Gamble. I was able to buy those at what I think were pretty decent prices. And so I think I started off on kind of the right foot. At the same time, I did kind of start off on the wrong foot. And I think we'll expand on this a bit more in the conversation. But when I first got into investing, buying all these different stocks, in hindsight, I think a better approach would have been to start out just buying ETFs instead of all these different individual companies. Because even though, there were a lot of them I still have today, I ended up selling out of a lot of those positions. And if I'm
mm,
being honest with myself, coming into this with no prior experience, no background in finance or accounting or, really anything of the sort, I really didn't know what I was doing. I really didn't know what I was looking for and what makes for a good investment or a bad investment. And on one hand, it worked out just fine. And I've certainly learned as I've gone. But on the other hand, probably wasn't the best approach. And so it's
mm.
not one that I would recommend to myself today if I had to start all over from scratch. But kind of just closing the book on this question, yeah, I don't remember things being too bad for me during 2020, only because I think I started at what was a very lucky time to start. I missed a lot of the chaos. But, we've had a couple periods since then where you've been able to feel it.
Mhm.
2022 wasn't a great year. What we're
Right.
experiencing so far in 2025 isn't a good year. And if you're going to be investing for any extended period of time, you'll go through these periods. And I think, as much as they can be kind of gut wrenching, they're also important periods to go through. You can't really avoid it, but it's important to understand how and learn and experience how you react to these situations, and that really make a big difference in your investing career.
And so much people forget that. Like we can see at Dividend Stocks Rock, we can see a lot of members that have been investing for a while, for maybe like 2 decades, and they never really experienced like a rough time that continues through time because like you've said in 2020 it was basically a V recovery, so it went down very fast, but it also went back up pretty fast. So it's important to remember that as investors we will face that. It's just a matter of when.
Yeah, absolutely.
I'd like to go back to these ETFs that you've mentioned. Like, do you see ETFs as a transition to individual stocks or like really a beginner counterpart or an investment strategy that is as valid as dividend stocks?
Yeah, I think it can be all of the above. I definitely think it's a great starting
Hmm.
point for, someone who's coming into this without a whole lot of understanding about how investing works or even what stocks are, because a lot of people don't even know that stocks are, they represent ownership in these businesses. We all know
Right.
these businesses, but a lot of people don't understand that that's what buying stocks are, is ownership of these great businesses. A lot of people just look at them as these things that randomly go up and down on a screen without rhyme or reason, which sometimes is true. But a lot of people don't realize it's a bit deeper than that. And so because of that, investing can be very intimidating when you first get into it. And so for that reason, I think ETFs are a really good place to start because you can get some skin in the game and start to learn the ropes without taking on a whole lot of risk. You can, come into this with a pre-made diversified portfolio
Hmm.
for you, and when you're, talking about something like just the S&P 500 or even SCHD, which from a dividend investor's point of view, I think is the holy grail of dividend ETFs, at least. I certainly think there are much worse ways to start investing, and I think it's a pretty
Right.
safe way to go. I don't really want to compare it to like having training wheels, but it can be like that. And I guess the good thing about ETFs is that it doesn't have to be a starting point to jump off to individual stocks because, you can just rock with ETFs for
Mm-hmm.
your entire life. At no point do
Mm-hmm.
you have to invest in individual companies if that's not something that you're interested
Right.
in doing. And I think that is actually an important thing to understand about yourself as an investor is how hands-on do you want to be in your portfolio? How active do you want to be in selecting these investments? And a lot of people don't want any responsibility for it. They'd rather just go on, they know they need to invest. They want to just set some money aside and have someone take care of it for them. And that's where ETFs are great. It can grow out of sight, out of mind in the background of your life as you do other things. But, for people who are a bit on the crazier side, maybe have a bit of a screw loose, like myself, maybe you are interested in this stuff. Maybe you're curious to know about why these businesses, like what makes them good investments. And I don't know, maybe you have certain affinity for these different businesses. And, if you are someone like that, then this can be kind of a fun hobby. It can be a fun activity. And, it's also kind of like you're a collector. I also, outside of investing, kind of a sidebar, I like to collect watches. I don't have a super huge watch collection. I don't really buy expensive watches or anything like that, but it's kind of similar. There are certain watches that just jump out to you. Maybe you like the way they look,
Mm-hmm.
maybe you appreciate the movement or whatever other intricacy about them. The same can definitely be true with individual companies. And so if you have that itch, it's good to know that you have that option. But if that's not your thing, you can just stick with ETFs and do just fine. Or you can do a
Right.
combination of the two. I'm kind of notorious for saying there's more than one way to skin the cat. And I know there's people listening who are laughing at me right now, but it's true. There's so many different ways to do this. And I think that's the beauty of it.
Right. And you are currently 80% in individual stocks and 20 in ETFs. So why did you choose that asset allocation?
Yeah, I mean, truth be told, it's something that I kind of stumbled into. I wouldn't say that I actively chose that breakdown. And I think the extra weighting in individual companies just comes from me starting out investing in individual companies. And for a long time, I was, putting most of my money in individual companies. It wasn't until a couple of years ago that I started investing in ETFs. And now these days, I actually invest more of my weekly contributions into ETFs. So slowly over time, the gap between the two will close. It'll definitely take some time to even out, but it wasn't something that I chose on purpose. And over time, I don't know how long it will take to get there, but I would imagine that ETFs will at some point become, evenly split with the individual holdings. And at some point from there, if I keep investing more and more into them, they'll overtake the individual companies in my portfolio. And if we look at the individual breakdown across the portfolio, the ETFs actually are two of my largest holdings. Like SCHD is my largest holding. I think it makes up maybe 10 or 11% of my total portfolio. So it's right up there in the number one spot. And then VOO, the Vanguard S&P 500 ETF, I
Mhm.
think right now is like my fourth or third largest holding and is quickly making its way into the number two spot. So it won't be long until those are the two largest positions that I have.
So you're basically rebuying the same ETFs right now. And you
Yeah.
okay,
Yep. Dollar
sounds good.
cost averaging into both of those every single week, which is a good way to go. Like for people who just want to invest in ETFs, it's just such an easy way to do it. Just set aside a certain amount every week, every month. Don't even think about it. Don't even question it. Don't even worry
Mhm.
if tariffs are bringing share prices down or Nvidia's pushing the market up or you don't have to worry about what craziness is going on because there's always going to be something. You can just set aside your money and move on.
Right. But don't you believe that many investors, many ETFs investors have like maybe the fear of missing out or something and like they go out and buy 5, 10, sometimes even 20 different ETFs and at some point I mean it's not a strategy anymore, right? Do you see that also on your side?
Oh, 100%. 100%. I'm very glad you brought that up too, because, I'd be curious to get your thoughts on this too. I really think you only need just one or two. You could get by with just one ETF. You could just buy the
Right.
S&P 500 and call it a day. You could
I
have
agree.
two or three different ETFs and, have each of them be different enough and so be very diversified. But I think once you get beyond that, to your point, there starts to be a lot of overlap between the funds. Like
Hmm.
on my channel once a month, I'll usually do like these different subscriber portfolio reviews. And one of the most common things I see is investors will have funds that overlap in a big way. It's actually not uncommon to see some of these investors have two or three different S&P 500 funds. that are
Right.
exactly the same thing. So yeah, I definitely think it's easy to go overkill when it comes to the ETFs, but at the same time, it's not entirely these investors' fault, because every single day there are these new hot investment products being shoved in your
So
face,
true.
especially if you're someone who spends a lot of time on YouTube. You'll hear about a new ETF every single day, and it's so easy to think that you need to add that to your portfolio. And so with that said, it's easy to get caught up in the mindset that you need to have, kind of like you were saying, 20 different ETFs. And I think that's especially true when it comes to the covered call ETFs. I mean, actually, don't even get me started on those, because it's a can of worms. But long story short, yeah, it's so easy to just over diversify and have too much overlap with the ETFs. Just, one or
Right.
two or three max. That's all you need. Do you feel the same
Yeah,
way?
of course I do. I mean, I'm not the expert in investment. Like Mike has all the financial knowledge and all that, but from what I've learned over the years and from what I've seen from members and people I talk with, it's a big problem because I mean, like you've said, it's not entirely investors' fault. They just don't know. But you need to get informed. You need to get educated because I mean, it's not gonna bring the returns and results that you want, basically. So I was just about to say, why not go as simple as possible? Even I mean, that's the goal with ETFs, right?
And I
Keep
think
it
you hit the
simple.
nail on the head. It's sometimes people just don't know any better. And this stuff can be so confusing. It can be, like I said earlier, very intimidating. And so, just a lot of people don't really know exactly what the right or wrong move is. And to an extent, there isn't a black and white right or wrong, but there are some clear rules and principles that you do need to follow. And also some common sense that you can deploy even as a beginner investor. And kind of using the example I used a moment ago, you don't need three different S&P 500 funds. As far as like dividend focused funds too, you maybe need one good one.
Yeah,
So
right. Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So, with that in mind, like, do you have any tools, articles, books, podcasts, YouTube channel? You have one that helped you and that would maybe help investors out there.
yeah, there's so many great resources out there, and more so today than when I first started investing. I've really seen the investing community, number one, but diving a bit even deeper, the dividend investing community has just grown so much these last handful of years. Like when I first got into this, there was maybe, I think you could count on one hand like the big dividend investing channels. Now there are so many, and the same is true with
Mhm.
podcasts as well. And so many have, just kind of been created over these last handful of years, which is great. So there's a lot of fantastic resources out there. But I would say that, on YouTube, I feel like I could spend so much time just like name dropping all these great channels, but I don't even want to. There are just a lot of great channels on YouTube. I think that's a great place to look. Podcasts, I mean, your guys' podcast is obviously great. There's not as many podcasts as channels, so it's a bit easier to like narrow them down. Dividend Talk has been a staple listen for me
Mhm.
every week too. The Dividend Mailbox is another fantastic one. I don't know if you've listened to that, but there's a handful of other dividend investing podcasts. Oh, I got to shout out my man Russ, Dapper Dividends, of course. And then books. Let's see, what dividend investing books? Let me look at, I don't know if you can see, I've got my little library back there. One dividend investing book I think every dividend investor should read is The Ownership Dividend by Daniel Paris. That was a really good one. Some other just general investing books that I think are really good would be Investing for Growth by Terry Smith. I think that's a great one. Investing: The Last Liberal Art by Robert Hagstrom. That's a great one. What I Learned About Investing from Darwin by Palak Prasad. All three of these books are fantastic. And I also think if you are someone who wants to get into individual stock investing, who wants to own individual companies, you should pick up a copy of Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark. It's a super easy read. Basically, the book just takes you line item by item into each of the things you'll come across on the financial statements, the income statement, the balance sheet, cash flow statement. So you'll learn about the revenue, the gross profit. You'll learn about the total debt, the net debt, the free cash flow, the operating cash flow. You'll learn about
Hey,
everything.
like basically all the basics that you need to analyze stocks, right?
Exactly. And they break it down in such a simple way that if you are starting to do this with no experience, it makes it really digestible and really easy to learn about that stuff. So that's definitely a must buy, I think.
That's a good idea. So, Ryan, your goal is to live off your dividends within the next 10 to 15 years, I believe. So, many people with that goal in mind would select high yielding stocks, which you don't necessarily. So, why do you believe in dividend growth rather than dividend yield?
Such a good question. And, truth be told, I think both are important. In my portfolio, I really try to strike a balance between all of the different types of dividend stocks. And when it comes to dividend yield and dividend growth, they exist on a spectrum, or the different types of dividend stocks. It is a spectrum from low
Mhm.
yield to high yield, from low dividend growth to high dividend growth. And then there are some unicorn stocks that kind of offer the best of both worlds, and are a bit
Mhm.
moderate in both departments. And just to give you all some concrete examples, if we're talking dividend growth stocks, typically that's characterized by, having a lower starting yield, maybe somewhere between 1 and 3%, with a higher dividend growth rate. Personally speaking, I consider like anything 8%, 9% or above to be, a respectable dividend growth rate. I'd consider that like a dividend growth stock. So you have that on one end. On the other hand, you've got high yield stocks, which are kind of the opposite. They've got high starting yield, maybe 4, 5, 6% and higher, with dividend growth rates that are a bit lower. Maybe you're getting like a 2% or a 3% dividend growth rate on average. And then you've got some others in the middle. And I think actually SCHD right now is a really good example of that, because with the drop it's seen, you're kind of getting both. Like right now, you could buy SCHD and get over a 4% dividend yield, starting dividend yield, which is great. And you're able to get a double digit dividend growth rate, like maybe 11, 12%. And so that's just kind of like the best of both worlds. And it's such a
Right.
unicorn to find. Typically, you don't, most dividend stocks are going to be kind of on one side of the spectrum or the other. But all of that's to say, I try to strike a balance in my portfolio of all these different things. I have some high yield dividend stocks with, some pretty juicy dividend yields: Realty Income, Main Street Capital Corporation, Altria Group, Blue Owl Capital Corporation, which I've been buying a bit more lately, which has like an 11.5% starting dividend yield. So that one's up there. I have those. I've got the dividend growth stocks like the Lowe's, Snap-ons, Williams Sonoma, Starbucks is there, even SCHD, I suppose. So I have the stocks on the other side of the spectrum as well. And then I've got some of those, stalwart, steady companies that may not be the fastest growing stocks. They may not be the highest yielding stocks, but they're ones that you can really depend on. They're ones that you can really sleep well at night owning. The Procter and Gamble's, the Johnson and
Right.
Johnson's, companies like that. And so I like to keep a mix of all these different companies in my portfolio. And in doing so, I guess what I'm trying to do is get the best of all worlds. I want, respectable dividend income coming in today that will continue to grow at an adequate rate over time. Because, like you said, my goal is to maybe not completely, but at least start using some of my dividends sometime in the next 10 to 15 years. Kind of the timeline I'm looking at. I'm 31 right now. And my hope is that maybe by the time I'm around 44, 45, somewhere in there, my
Mhm.
portfolio will be bringing in about hopefully $2,000 per month on average in dividends. And at that point, if I can start even using just $1,000 to pay my bills, that's really going to go a long way. And I think that from there, I'll slowly transition into using more and more of the dividends as they continue to grow. But because of that goal, because I want to use some of those dividends sooner than later, and also because I need those dividends to continue growing over time. And I think everyone should have that expectation and have that as part of their strategy to keep that income growing, because I need
Mhm.
both of these things. I need exposure to both types of dividend stocks. And I just think too, just because we experience different market cycles, and different types of stocks in different industries and sectors will perform better than others, just depending on what's going on. And so from that point of view as well, I like to keep a well-rounded approach. And ultimately, what I've experienced is when times are good and when the market's going up, sometimes I'm able to outperform the S&P 500 on the upside. Not always, sometimes, but
Right.
usually I'm still able to see at least decent share price returns and total returns when things are
Mhm.
good. And when things are bad, like they were in 2022, like they are so far right now, my portfolio sees much, much less of a drawdown. Like I don't know exactly what the S&P is down so far this year. It might be 12% or 13% or something along those lines as we're recording this. I think my portfolio is only down about 6%. And in 2022, when the S&P was down close to 20%, my portfolio was down like 0.2%. So, and I'd rather it be that way. I'd rather be a bit more defensive and a bit more protective. That's just
Mhm.
kind of my temperament and kind of my nature. So all of that's to say, I think this well-balanced, well-rounded approach, this all-weather approach, as I really like to call it, is what I shoot for.
All right, so your largest sectors are real estate and consumer discretionary. So why do you feel more attracted to those? And how do you, like you've mentioned a well-rounded strategy, how do you maintain a good sector balance as your portfolio grows?
It's a really good question. I think for me, I just inherently understand those sectors a bit more. How real estate investment trusts generate revenue is just so straightforward to me. And like I've said a couple times, I came into this without knowing anything about it. So I need businesses that are easy to understand. And the same is true with when it comes to a lot of the consumer discretionary companies. I can understand how Starbucks makes their money. I know Williams Sonoma. What other discretionary companies do I own? I'm trying to think. I don't know. But anyway, the moral of the story is they're just kind of in my wheelhouse. As Warren Buffett would say, they would fall within my circle of competence. And I think at the end of the day, that's what you need to follow. And that's a lesson that I've learned the hard way. I've certainly invested in companies that were just like way too over my head. Intel was a really good example of that. I kind of on a very, very surface level understand what the company did, but I couldn't tell you what makes an Intel chip better or worse than like an NVIDIA chip or what have you. And so it's something that I had no business investing in. And for that reason, I would say that I'm more drawn to the real estate and consumer discretionary sector, but also part of the reason that the consumer discretionary sector particularly makes up such a big weighting in my portfolio is because I've had some investments in that sector do really well. Like Williams Sonoma, I think right now I'm up about 120 or 130% on it. Prior to this really big drop, I was up about 220%. It's definitely seen a pullback.
Wow.
And so that's a big reason why that sector is so weighted, just because I've owned
Mm.
stocks that have worked out. And I think, you'll have some of those every once in a while. You'll have some investments that just really take off, and those can really change the diversification of your portfolio, not necessarily on purpose. That's just kind of how the cards are dealt. And I will say too, I don't really spend a lot of time thinking about the sector diversification in my portfolio. I used to when I was first getting into this stuff, in my attempt to have this well-balanced all-weather portfolio, I wanted to have a bit more of a balance between the different sectors and
Hmm.
even on an individual stock level as well. But these days, I don't know. From a sector point of view, I don't really spend a whole lot of time thinking about it. I more so just look at things on an individual company level. And if I think a company is good and it's worth investing in and I understand it, then I guess I don't really question so much which sector it's in. I try and just look at it more on an individual level. Does that make
Hmm.
sense?
Yeah, I mean, as long as you're comfortable with everything that you own, which seems to be the case. So, I mean, it
Yeah.
makes sense. But when your stocks are very well performing, like you've mentioned, Williams Sonoma, is there a point where you will sell some of your shares or you just keep as they go and you don't mind getting into maybe 10, 15, 20% for exposure to the same company?
Yeah, truth be told, I don't know if I have a conclusive answer about this because I go back and forth in my head all the time. Williams Sonoma is probably the best example of where that's the case because, in hindsight, seeing what the share price has done really just these last couple of months, I would have been better off if I would have sold, right? Like coming into 2025, it would have been a good idea to liquidate my entire position and buy back in like right now. But at the same time,
But that
at the
goes
end of the
back to timing the market, which is
yeah. At the
almost
same time,
impossible to do.
I don't know what the market is going to do tomorrow. And I have seen days where Williams Sonoma has jumped 25% in a day. I've seen it. And I've seen the opposite too. But that's the point is you just never know what's going to happen. And at the end of the day, like, I think it's a good business no matter what the share price is. And what am I trying to do here? I'm trying to own good businesses. It's nice to see the share price up and it does suck when it goes down. But specifically for us dividend investors, is that really the only thing that matters? Is where the share price is that really why or where it's going to go? Is that really why I'm buying these assets? I
No.
don't know. I always go back to that from a dividend investing point of view. And I think there's this whole other dimension to it. And that's what keeps in that dimension is the dividend, obviously, but in collecting that cash flow. And so I always come back to that. And I think that's what keeps me holding on to these companies for better or for worse. And in the case of Williams Sonoma, like I'm actually glad that I didn't sell it because, I sell it and try and time my entry back into it because like the company, even though it's down, whatever it is, it's down this year so far. They just raised their dividend like 16%. And so it doesn't seem to me, and I listen to all the earnings calls and stuff like that, and nothing is fundamentally wrong with this company. Maybe it got a little bit ahead of its skis when it ran up as much as it did. But at the end of the day, I think this is a good company and I want to hold on to those. So
So
it's
you
kind of what I
wouldn't
always go back
also
to.
you wouldn't like without selling everything, just like skim a bit, like you wouldn't do that either.
I guess that would be the compromise, right? But then I think, well, where would I want to invest that money? If I'm going to sell out of a position, where am I going to redeploy it? And I guess I
Right.
could hold on to some cash. That would have been coming into this situation today. That would have been fine. Yeah, like I said, there's so many different ways to skin the cat, and I don't know what the right answer is. I don't even know if there is one.
That's okay. I mean, like I've said, I believe that what's the most important thing when you invest is just being comfortable with what you do. So
Yeah.
if you sleep good at night, that's totally fine, right?
Yeah, yeah, absolutely. And I guess like the silver lining too is, when things get cheaper, when things do see a pullback, it just creates a good buying opportunity. So I am happy to see that. So I don't know. I think you could make the argument either way, for sure.
Right. Okay, so you've said that Visa was one of your favorite stocks. So what makes it like the gold standard for you?
Oh, great question. So first and foremost, just from a numbers point of view, if you look at Visa's financials, if you look at the revenue, if you look at the earnings per share, the free cash flow, if you look at the balance sheet, just from top to bottom, it doesn't get more picture perfect than Visa. Everything is just the growth metrics, the revenue, the earnings, free cash flow, everything is just straight up and to the right without skipping a beat. A pretty nice growth rates too. We're talking double digit growth rates on average over the
Mhm.
last 5 years, even 10 years actually. Regarding the debt situation, the company has like negligible debt, more than covered by their annual free cash flow. So it's really not at any risk of going out of business anytime soon, or at least going bankrupt, I should say. So quantitatively, it's looking good, and all of that trickles down into the dividend as well. The starting yield's not the highest, it's less than 1%, but you're getting really, really, really solid dividend growth
Right.
and also really solid returns on invested capital. So the money that they're reinvesting back into the business is being put to great use. And so it has a lot of good stuff going for it there. But then if you just think about what the business is qualitatively, there's a lot of tailwinds for it as well. I mean, as time goes on, it's no surprise that people are using cash less and less, and they're using their cards more and more.
Hmm.
And that's obviously going to benefit a company like Visa. Along with that, the company benefits from just a really solid network effect, this flywheel to where the more that people use their credit cards to pay for things, the more valuable Visa's network becomes. And the more
Right.
value that the network has, the more that businesses where it's not already being accepted in other parts of the world, the more that they'll want to be a part of that network.
Hmm.
And once they become a part of that network, that's going to make the network even more valuable. And then more users will continue to, get Visa cards and whatnot. And so it creates this sort of flywheel where the more people that use the network, the more value it gets, and the more merchants that will want to come onto the network, which will then make it even more valuable. And then this is just a cycle that continues to repeat. And because, things are trending more and more towards plastic and less with cash, this tailwind and this flywheel should continue to grow at least for the foreseeable future. And there's talk about cryptocurrencies or decentralized currencies or other
Right.
types of, payment vehicles or currencies even. And I don't know exactly what that's going to look like, but I can't imagine that Visa won't be a part of that in some way, shape, or form. And so we'll see what happens. But it's just, from for all of those reasons, it's just a business that I think very highly of, both qualitatively and quantitatively. Like you said, I call it the gold standard for those reasons. And as far as individual companies go, this one right now is the largest position I own. And man, I was really hoping to see it pull back a little bit more than it has. We'll see what happens from here, but I'd love to see Visa get back under around $300 per share, because I'd start buying it again, even though it is pretty overweight in my portfolio. I love it so much.
And I mean, I think we have to mention that Visa and MasterCard also, it's the same business
Hmm.
model pretty much. They don't manage the debt risk from their users. Like they are just payment processors. Like the financial institutions are the ones managing debt for the credit card users. So
Yeah.
it's very interesting because I mean, they don't mind what people owe to the bank. It doesn't make a difference for them, right?
Yeah, I'm really glad you brought that up. And that's one of the big misconceptions about the company is they're not on the hook for the credit card debt that people take on. And you hear this all the time where, I mean, you've heard it more as time goes on, I should say, where, people have higher balances on their credit card, or maybe are at higher risks of default, or, something like that. But that's not as big of a concern for Visa, because they're not on the hook for that. It's the
Right.
card issuers, which would be the banks. And companies like Visa and MasterCard, they don't have to worry about that. But another similar company that gets thrown into the mix, which is American Express,
Mhm.
actually is a little bit different. In addition to being a payment network, they also issue cards. So they are on the hook for their clients' line of credit or outstanding credit, I should say. And on one hand, that creates an additional revenue source for them because they can generate that interest income. But on the other hand, that adds another element of risk. So there's a pro and con to it
Mm.
for sure. But yeah, Visa, MasterCard, just the network. And that's partly why I think their margins are so high. I think Visa's gross profit margins are something like 80%, maybe even a bit higher than that. And that's pretty unbelievable.
So you've said that if Visa would go down a bit, you would buy more. So I'm curious to know about your buying and selling process. Like, how do you decide when to add to a position or when to walk away? Like, do you have like maybe 3, 4 must-have metrics, trends? Like, what's your strategy basically for buying and selling?
That's a great question. It's something that I'll probably continue to refine over time. I think it's a constant work in progress. But at this point, I would say there are a couple different things that I look at to help me gauge whether or not a company's at a good price to buy. I will say these days I don't do as many discounted cash flow analyses as maybe I used to. And that's a very popular, in case you've never heard of that before, it's a very popular way to value stocks. It basically takes a company's projected future cash flow and discounts it back to today and tries to tie that to what would be an appropriate price to buy or a fair value. And it's hard to know. It's hard to know what a company's cash flows are going to look like
Mhm.
moving forward. And so I've kind of gotten away from doing those, and instead I'll look at some more relative valuation metrics. Like I think one easy thing for especially dividend investors to do is to compare a company's current dividend yield against its 5-year average dividend yield.
Right.
And this is something I think Mike has talked about before. This might even be
Mhm.
where I picked up this idea, but companies tend to trade within a certain dividend yield range. You don't often find over a long period of time that companies will be priced at a place that is too far outside of a certain dividend yield range. Like we can look at Lowe's, for example. Their, dividend yield range might be somewhere between maybe like 1.8% to maybe 2.2% on the high end. And obviously, the cheaper the stock gets, the higher the dividend yield goes. So if you see a company whose current yield is a bit higher than their 5-year average yield or even their 10-year average yield, that could be an indicator that it's trading at a historical discount, just on a relative
Mhm.
basis compared to where it historically sits. So that is something I keep an eye on. I do a similar thing when it comes to the free cash flow yield. It basically compares a company's free cash flow against its market cap or its free cash flow per share against its, share price. And this is something I picked up from Terry Smith, going back to one of the books I mentioned earlier, Investing for Growth. So this is a valuation metric that he does. And what he'll do is he will compare a company's free cash flow yield against the 10-year treasury bond, I think it is. And his rule of thumb is if a company's free cash flow yield is a percent higher than the 10-year treasury yield, then it's probably a good valuation. And that 1% difference between the two accounts for any risk premium, the risk premium that you would want for owning an
Mhm.
asset that can fluctuate in value, go up or down. And that's something that I do as well. So, like, for example, if I think the 10-year yield right now is 4.2% or something along those lines. So, based on that, way of doing things, you might want to look at a company whose free cash flow yield is sitting at 5.2% or above. And I'm not super strict on that, but I will say looking at those are probably the two main valuation metrics that I use these days, at least. That might change down the road, but it's simple, it's straightforward, and conceptually it makes sense to me. So that's kind of why I go with it. But that's not it though. Like when it comes to the companies that are already in my portfolio, I also compare their price against, my own cost basis. If a company is trading pretty close to my
Right.
average cost per share, close above it, then I don't have any issues buying it. And
Mhm.
obviously, if a company is considerably below my average cost per share, which I've got a couple of those right now, Starbucks just
Mhm.
actually dipped down below my average cost. Then for me, it's a good time to buy no matter what because you can better your position in those companies and lower your average cost per share and overall establish more of a margin of safety. So that's definitely another thing I take into consideration, especially when it comes to companies I already own. I'd say that's probably the first thing I look at is where it is in relation to my cost basis. And then companies outside of my portfolio, I more so lean towards the other two things that I talked about.
And what makes you sell a position in your portfolio?
Let me think about that for a sec. So there's a few different things I guess that can make me want to sell. One of them I think is a standard rule. Like if something about a company fundamentally changes, like if, Lowe's one day decided they were going to start selling like Barbies or something. That might make me question whether or not I want to own it, because it's just so vastly different from what the company does already, just so outside of its wheelhouse. So that's one thing. If the company fundamentally changes in a way that doesn't really sit well with me, if I start to see the financials deteriorating, that's another big red flag as well. Walgreens is actually a great example. I didn't own Walgreens, fortunately, but I think the writing was on the wall for that company for a long time. The revenue had been increasing, but if you look at the earnings per share and the free cash flow per share, those were going down over time. And so, I want to be honest with myself and objective about the companies that I own and undeniably have an affinity for. If things are heading in the other direction, you need to be objective enough to look at that and say, it's not heading in a good direction. And, share price tends to follow the earnings and free cash flow growth. So eventually that'll only mean one thing for your returns in that position. So I think that's another thing I try to look at. Number 3 is also kind of weighing the opportunity cost. Like if you've got positions, how do I say this? Let me see if I can come up with a good example of this too. So if you own positions and you think that there is a better use for that capital, then it can make sense to sell out of those positions and reallocate elsewhere. Like I believe I recently did that with Coca-Cola. Not in this, sometimes the positions you sell out of, they're not bad businesses, but sometimes they're just rather other places you'd rather put your money. I sold out of Coca-Cola and put that money into Visa. And I think from a long-term perspective, I think I'll get a lot higher total returns out of Visa than I will Coca-Cola. So I think it was a good move there. That's one example. And I would say that those are probably the 3 big things, opportunity cost, declining fundamentals, fundamental changes.
Listeners, let's empower you in the investment world with our free Dividend Rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. So, Ryne, I would like to ask you a funny question. Like, what's the one investing myth you'd love to debunk today?
Oh man, this is a good one. I want to hear one from you too, because this is a really interesting question. So one investing myth that I'd like to debunk. Okay, I have a good one for you. So when it comes to dividend investing, I think that there's this belief, it's a mistaken belief, that by buying dividend stocks, you are somehow subjecting yourself to a lifetime of subpar returns. Like the thinking is, if you are buying dividend stocks, you are automatically going to underperform the market. And in my opinion, and actually in my experience, that is such a big misconception. It's so wrong. It is more than possible to invest in dividend paying stocks and see better total returns than the market as a whole over a long period of time as well. And I think one of the reasons this is a common belief is because of dividend stocks maybe not seeing as aggressive upside as some other growthier companies, like, maybe a SoFi or a Palantir or an NVIDIA. There's a big belief that those aren't going to see as much upside as those growthier type of stocks, which may be true. It really depends. That may be true. But that also doesn't take into account the whole other side of this equation, which is the downside. It's so easy to forget that things can go down. And kind of like we've touched on already in this conversation, when the market's heading south, when it's going down, dividend stocks can really save your butt during this time. And it's very possible, and it's also very likely that by owning these highly profitable dividend paying stocks, you will see less losses than if you were invested in other more speculative, potentially more high flying things. And I think when you combine those two sides, upside plus downside, that can result adequate upside with less downside, that can result in overall outperformance. And I will say that's been my experience so far. And I see people say
Hmm.
that all the time. Like, good luck good luck being a loser your whole life. And I'm like, I just don't really get where that comes from. But that's a
I
huge
don't
myth
know.
that I think needs to be forgotten about.
Well, if I have to share something, I mean, I think it goes along with what you just said, and it's that the stock market is not necessarily made to become rich like quickly. Like this is not the casino, this is not a game. This is like it's real money, it's hard-earned money also that you've worked for. So I mean, don't put your money in the stock market thinking that like for the next 5 years are going to become rich. That's not how it works. Like you need to understand how the stock market works, and it's not made for that. It's made for having a long-term investing strategy and investing like consistently. And when you do so, then you'll have like a very flexible life with full of wealth if you'd like. But I mean, it takes money to make money, you know what, in a way, right? So it's not magic. It's not going to happen overnight.
It takes a lot of patience. And to your point, like, that is the hardest part. And I think that's a big reason why people seek other seemingly faster ways to build wealth. But, at the end of the day, and this is a lesson a lot of people have to learn the hard way, at the end of the day, there's no shortcut.
Some people may have like been lucky over time, and like you can hear stories like this guy like make this and that and whatever, but the reality is that it's a tiny percentage of people, right?
Yeah, and you
So
only hear about the winners. The losers, the people who
exactly.
did that type of thinking and that type of approach didn't work out for, they fade into the background and you never hear about them. And so you're left to
Hmm.
believe that, maybe that type of strategy is more successful or has a higher hit rate than it actually does.
Right. Okay, so let's go maybe a little bit more personal to end this episode. So, as a content creator focused on dividend investing, how has teaching others impacted like your investment discipline and strategy?
Well, a couple of different ways. When I first got into making videos, making YouTube videos and whatnot, I knew that it would be a really good way for me to learn more about this stuff myself. I figured that if I was going to be talking about it, it would force me to learn more about it. And I was
Sure.
so gung ho about this stuff. I loved it. I still do today. Like, I'm just as excited about dividend investing today as I was when I first started. But I knew that this was going to be a really good vehicle to learn more about the craft and develop my skill set doing this. So it definitely taught me a lot. Just being a practitioner and having to talk about it definitely teaches you about it, number one. But also number two, like, it helps keep you honest, for better or for worse, I wish this wasn't the case. And I really try to discourage people from doing things just because I do them, but I don't think it happens that often. I'd probably be flattering myself to think it does, but
I no, I don't think so.
but
Because
it does
I know
have.
people do the same with Mike. So I mean,
Well, but so it does happen at least a little bit, and I don't even think it should happen that much. And but the
mhm,
fact that it does, and the fact that that's not something that I or Mike or anyone else can control, at least for me, it motivates me to try and always do the right thing and always try and give. I don't want to call it advice, but like put out sensible information and practical information. And also when it comes to talking about certain securities, actually believing that there's some merit to them as an investment. And I talk about a lot of stocks that I don't personally own, and I'm okay with that because I think that there's a lot of, just because I own something doesn't mean that someone else isn't going to find some value in it or will see some
mhm,
merit to that potential investment that I don't personally see. So it's good to throw different ideas out there. But nonetheless, I try and at least talk about things that have some potential to them. I don't want to just talk about things that I know are bad investments. And
right.
this is a big reason, and I shouldn't kind of make this a blanket statement, but this is a big reason why I really don't talk about covered call ETFs on my channel. I really don't think they're all bad. I think there are some fine ones out there, but I also think that there is a lot of junk, and that's kind of going back to our
Mm.
earlier conversation. There's a new one popping up every single day. It started out with the JEPIs and the QYLDs and XYLDs, and all of a sudden somehow we've gone from those monthly paying funds, which I still think those are good funds, to then weekly paying funds. And it's not going to be a long time until we're seeing daily dividend paying ETFs. And at the end of the day, and if you look at them too, they'll have like a 90 something percent yield, which, come on, you got to look at that and think there's got to be more
Mhm.
to this story here. There's no free lunch there. And so that's,
Exactly.
I avoid any type of fun like that on my channel just because it can only do people harm, I think, by talking about them in a
Hmm.
positive light. Maybe they'll make you some money in the short term, but from a long-term perspective, which is really where your focus needs to be, it's not going to work out well. There's no way you're going to be able to be generating a 90% yield over 10 years or 20 years or 30 years. Come on, you know better than that. You know.
Well, I mean, if you get that, there's something else that you lose. It's just as simple as that. You can't have everything in one investment. It's impossible.
Yeah, absolutely. So all that's to say though, like it makes you want to try and do the right thing. And that's a
Hmm.
subjective thing. Everyone's going to have a different opinion on what that is. And all I can do is do what I think is right. But that's kind of the moral compass that I try and follow.
And you've shared also that you're passionate about progress in all areas of life. So, how does that mindset influence your approach to long term investing, to financial independence, and I mean, your approach in life in general?
Yeah, that's such a good question. And I apologize in advance because this is a topic that I feel very strongly about. And so I'll try not to ramble on it too much, be too long-winded with it. But when you think about something like investing, it's what's referred to as an infinite game. And essentially what that means is there's no finish line with investing. There's no portfolio value that you can reach where there's a cap. You can just keep adding to it and keep adding to it, and that thing can keep growing and keep progressing. And the same is certainly true when it comes to your dividend income. So essentially, it's a game where there is no finish line. And if there's no finish line, then the way to win this game is to just continue taking steps forward and to continue making progress. And I really like that about it. I think if you can just continue to put one foot in front of the other over time, like those small incremental steps will compound literally into something completely massive and something that you probably didn't even realize when you first started, especially if we're talking a timeline of the rest of our lives. I'm only 31 years old, and I'm hoping I have at least another good 50 or 60 years of playing this game, hopefully even longer. And this portfolio that I'm building today will extend far beyond when I'm here too. And so even if I'm no longer here, that game can still continue to be played. And so at the end of the day, the name of the game is progress. That's true when it comes to building up your portfolio. That's true when it comes to learning more about investing. There's always something new to learn. And there's always progress that you can make as an investor in honing this skill set. And, outside of just investing, this same principle applies to so many other different things that I'm interested in. It applies to, I've been into like weightlifting for the last, I know I don't really look it, but I've been into weightlifting for the last probably 15 years now. As soon as I got out of high school, it's something that I picked up. And it's the same thing too. There's no cap on where you can reach and where you can go and what you can develop. And so it's just all about making incremental progress. And you don't walk into the gym on day one and just start bench
Hmm.
pressing 225 pounds. You have to start probably with the bar or maybe even less, and you work your way up and you make progress along the way. And that's another infinite game. A third one that I like to play is, and I think that you mentioned that your husband's into this too, is running. I think you said that
Yes.
he's a really big marathon runner, right?
Right, right. He has run like 40 plus full marathons. He did like
Jeez.
Ironmans, triathlons, and all that stuff. I mean, it's so impressive. And he doesn't train that much because we have like three kids and they play hockey and do horseback riding. So like he runs about an hour, 3, 4 times a week.
Wow.
That's pretty much his training. And
Okay.
he
But
does all
that's
that stuff.
that's still great. So he's probably still able to get in 25, 30 miles a week. Do you guys use kilometers up there? Maybe it's kilometers in your neck of the woods.
Yeah, but it's okay.
Okay, nonetheless. And I don't know the conversion or else I would have used it. But anyway, running's another infinite game, like you can continue to just run more miles and better your time if you're a marathon runner. You can just continue to run at a faster pace and make progress that way too. I guess there's multiple ways to continue progressing there. And there is no finish line. There is if you're running a race, you can finish the race, but
Hmm.
as far as your training goes and making progress in that, you can just continue to take steps forward. And no matter what it is, whether it's any of those three that I just mentioned or even your career or other things in life, I just think these infinite games are, to me, very, very interesting games to play. And they're all the thing that's in common about all of these games is that you don't have to have an innate talent or a high IQ or some sort of natural disposition to play them. You can start at ground zero and
Hmm.
work your way up. And so really any of these things are things that anyone can do. And they're all very positive things to get into as well. And I think if you can make progress in any one of these areas, it will trickle over into other areas of your life. making progress in the gym gave me the confidence that I could make progress elsewhere too. And it gave me the
Right.
confidence that I could set out to do something else. And maybe I'll suck when I start. Maybe it's a YouTube channel that I want to do. Maybe it's true. If you go back and watch my first videos, which please don't, because you'll probably throw up, but it was
Well,
true.
don't listen to our first episode either.
But that's just one of the things that you have to go through, and you get better over time. And so that principle can really trickle into other areas of your life. And for me, I get a really big sense of fulfillment out of that, no matter which one it is, making progress in any of these areas, and all of them benefit your life in their own ways. And so I think they're pretty important things to have.
So thank you so much for your generosity, Ryne. It was such a pleasure to have you. And I've had the impression to talking to a friend all this time. So really
well, that
great.
means a lot. The feeling's definitely mutual. And I want to say thank you so much for even considering me to be on the show. It was really fun chatting with you, and I'll do it anytime. Really, this was awesome.
Well, thank you. You're
Yeah, thank
welcome
you.
Anytime you want. So listeners, this episode showed you the right mindset and discipline to build wealth using dividend stocks. Not just dividend growth stocks, like Ryne said. For the show notes and the links to Ryan's YouTube channel and newsletter, visit thedividendguyblog.com/229. If you enjoyed this podcast, hit pause and click the subscribe button underneath our logo to avoid missing any episodes. If you'd like to appear on the show, message me on the Dividend Guy blog Facebook page or at the Dividend Guy on X. And until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.